the Director of Research. I'm pleased to introduce to you the management of Townsquare Media, a digital media company. Before we get started, I want to mention to you that I cover Townsquare Media. The stock symbol is TSQ, and I have it rated an outperform with a $21 price target. Yes, that offers a significant upside from where the stock is today, and I would hasten to add that the stock is currently offers a whopping 12.7% annualized dividend yield. It is one of my favorite in terms of offering the best total return opportunity in my coverage universe. And I believe that the company has an excellent management team to deliver on that strong shareholder return potential. And with us today are Bill Wilson, the CEO, Stuart Rosenstein, the CFO, and Claire Yeneke, Executive Vice President. Welcome, everyone. And so, this will be a fireside chat with no formal investor presentation. For those of you that are interested in the investor presentation, I would encourage you to visit their investor section of the Townsquare Media website. My questions are designed to provide some context on the businesses, the growth strategies and prospects for those businesses. And if you have questions that I do not address, please feel free to send those to me in your chat box. So let's go ahead and get started. So, Bill, Townsquare Media is a unique media company that services small markets in the U.S. Can you talk a little bit about what makes those markets at Townsquare Media so attractive?
Yes, Michael, and thank you for that introduction and overview. And I appreciate that first question because, we're obviously a micro cap and we're thinly covered, and not a lot of people are taking the time to really understand the company and do the research. And one of the key differentiating parts of our company is the fact that we've been focused on markets outside the top 50 since day one. The company was founded in 2010. Stu is a co-founder, and a real key differentiation is being in these markets where they're really news deserts. The newspaper industry has really obviously been hurt overall, but particularly in our size markets, a lot of newspapers have shuttered. Many of our 74 local markets don't have a local television station. So if people in these communities want to get informed as well as entertained, we are their primary source of that. And that's benefited us quite a bit. In terms of just our legacy cash cow radio business, we reach 1 in 2 adults in these communities just through our AM/FM broadcast. So 50% penetration and reach on a weekly basis. When you add in our substantial online audience coming to our websites and mobile apps, we reach 70% of the adult population in these markets. So that is highly differentiated. You would never be able to have that type of penetration and reach in a Miami, New York, Nashville type of market. It's also a lot less competition in the digital marketing solution space and in the digital advertising space. And we continue to build this competitive moat in each of those areas where we're providing what I would say national scale and sophistication to markets with an average population size of 300,000. So as people do their research about the company, the fact that we are so differentiated and stick to our knitting and being in these size markets, we believe is a core differentiator and one of the reasons we've outperformed the industry to date in terms of local media.
Townsquare Media has been at the forefront of developing a strong growth platform through developing its digital businesses, and it's been a leader in the industry. Now digital is over 50% of revenues, and probably more importantly, it's over 50% of cash flow. You have two media segments that I would like to talk about. You have Townsquare Ignite and Townsquare Interactive. And if I can just start with Townsquare Interactive, this is a subscription-based business model. And what's interesting about it is that other companies that have developed a subscription-based model like this, like Netflix and all sorts of other companies in that genre, typically have very high multiples. And it's strange that your company doesn't have that type of multiple, which we'll get to in a little bit. But let's talk a little bit about Townsquare Interactive because, coming out of COVID, it seemed like it was on a very strong growth trajectory, and then it kind of stumbled a little bit and lost its footing. And I was wondering if you can just talk about, where Townsquare Interactive is today, and when investors can start to see that revenue and cash flow growth from this segment to start to see that favorable growth trajectory that we were kind of had, prior to COVID.
Yeah, no, great tee up, great question. Thank you, Michael. So for those who may not be familiar with Townsquare Interactive, it is organically built, just like all of our digital solutions. One of the greatest assets of the company is our digital products and the digital team we have who are building these products. So this Townsquare Interactive was birthed out in 2013, so we're about 12 years into this. And what it is we're providing digital marketing solutions for SMBs across the US. And we're providing everything from hosting websites, building websites, but really the value proposition over the last 3 to 4 years has become managing and marketing, as well as everything from integrating into their QuickBooks, providing invoicing, payment. The CRM has been substantial, collecting information about customers coming to their website, collecting information about customers coming into their store. And then Townsquare Interactive will turn around and do email marketing, text-based marketing on behalf of that, all for an average price of roughly $300 a month. So it's very affordable. And it, as you said, has had a great run for a first decade from really 2013 to 2023. We invested a tremendous amount of money up front. And when you think about that period, we were growing revenue 7 to 10 million year in and year out. And we were growing profit 2.5 to 3 million year in and year out, like clockwork. As you alluded to, we hit some I'd say substantial changes in 2023. The first one was we really made some decisions that we knew would be painful for the short term. Going into this, we were like, this is the right thing for the long term. And that's the way we're always operating this business, but we're going to take on some pain in the short term. So the first one was return to work mandate on January 1st, 2023. We were probably one of the companies earlier to do that. I think you started to see a lot more in 2024. But after COVID, all of our employees down at Townsquare Interactive, which was numerous, over 500, were working remote. And obviously that started in 2020. So it was 3 years almost of them working remote. We mandated they come back to the office. We had them, we announced it, we phased it in over a 6-month period, but it was very disruptive because a subset of the team members there chose not to continue. So they wanted either remote work, and that was something we thought was not the best long-term solution for us. So that created a lot of disruption. The other piece that, again, was intentional and we knew would cause pain, but we believed would be the right thing long-term, was we completely redid our service model. It used to be a one-to-one model that if you were a business and a client of ours, you would call in and you'd get the same customer service rep every time and they would handle your needs. We went to a much more of a call center, interactive voice line, and we knew it would be disruptive to the current subscriber base, but it allows us to scale much more efficiently. It allows us to operate with much better profit margins, but more importantly, it's much better for actually the customers, because when they call in, their answer rate went to almost 100%, where before, if you had one person and they were on the phone with one of their other clients, it would go to voicemail. These businesses are super busy, so then we call them back and they'd be out in the field doing their work. So long story short is we did the right thing for the long term, but that was very disruptive because the people who were used to their one person, some of them canceled. So what that created was in 2023 and 2024, we lost roughly $7 million of cash flow profit over the course of those 2 years. This year in 2025, we've already returned to strong profit growth in Townsquare Interactive. It will be, if not the highest profit growth in terms of dollars year over year, close to it. So we've shared on our Q1 and Q2 earnings call that we expect roughly 3 million plus in profit in Townsquare Interactive. So we feel really good. Again, we took that pain, we made the changes, but it was the right thing. In terms of revenue growth, we expect that to continue to begin in 2026 and get back to historical levels of that 7 to 10 million. So we feel like we took that pain, obviously hurt us for a couple of years, but again, would make the same decisions again if we had to make them today.
Bill, the other aspect of interactive, it largely started as kind of like building out websites, managing, customer search optimization and things like that. And now it seems like you're expanding the service offerings. You mentioned CRM. Can you talk a little bit about the uptake in those service offerings and maybe your thoughts about new service offerings that maybe you can kind of look towards into the future? And as you do offer new services, do you think that you can gain some pricing ability there?
Yeah, so great question. I think one of the things I'm most proud about the team at Townsquare is just continually evolving and innovating. Particularly, that's true across the company, but in our digital products with our digital team that's building the products. So we have a history of doing that, and we'll continue to do that. So in terms of the uptake, at this point, it's really 100% of our customers and clients and subscribers at Townsquare Interactive are using the CRM. Which we didn't have 4 to 5 years ago. So it's been a significant change. There's always been the opportunity to have a low-cost website provider, be that GoDaddy or Wix or other ones. And now with AI, you can go in essence, create a website on the fly. That's really not our value proposition. Our value proposition is driving incremental customers and helping them manage their business from what I just described in terms of customer acquisition, customer marketing, payments, invoices, and all of that. And all for $300 ARPU on average. So in terms of pricing power, we believe we have that given the product suite. That said, we've taken the margin from 27% historically to this year 33%, and the service change was a big part of that. That's significant margin expansion, and that's why we made that change that was so disruptive in 23 and 2024. So where I am in terms of our view on this is let's keep the pricing where it is, even though we could potentially raise prices and still maintain, because we're continually able to get more and more efficiency in this division. So I'd rather get more and more customers in at this price point and continue to get efficiency and expand the profit margin. But couldn't be more pleased with the Townsquare Interactive team. It's obviously a hard thing to go through a setback. They got knocked down, and we made these decisions knowing that it would cause pain. But we had that long-term perspective. And here we are in 2025, growing profit $3 million this year. And we expect that to continue for the next 5 to 10 years. So quite pleased.
Are there opportunities to kind of improve margins there, like maybe using AI or any of the new tech buzzwords that we're all hearing about?
For sure. I mean, that's part of it. So a good chunk of it was the service change. Another small part of it that really we just started 6 to 8 months ago is deploying AI tools into Townsquare Interactive. It's probably we're utilizing it across the company, but I'd say Townsquare Interactive has been the most aggressive in deployment. We're using AI on the design side in terms of just efficiency, in terms of resizing things. We're using AI to listen to all of our service calls, to provide information about our clients when they call in on the fly. We're using it to listen to outbound sales calls and doing sales coaching. So yes, I think AI over the next 2 to 3 years will substantially help margin expansion in Townsquare Interactive. I expect the same thing in our Ignite division as well. So I think AI, and I expect this quite honestly for most businesses in the US or around the world for that matter, to really get efficiency by leaning into these tools and capabilities that in essence are really less than 12 months old in many instances. So couldn't be more excited about AI in general and how it's helping Townsquare today. But when I think about the next 3 to 5 years, I think it's incredibly transformative.
Well, that's a good segue into Ignite. This business has been on a tear. Can you briefly describe the business and what are the key revenue growth drivers for that business? And particularly as you look forward, what do you see as the growth drivers going forward?
Yeah, I mean, we couldn't be more pleased with Townsquare Ignite, our digital advertising segment. The fastest growing part of that component is the programmatic side. And that's why it goes back to your original question about the differentiation and being in the markets outside the top 50 that we are. We are bringing national scale and sophistication in a full digital agency model of doing everything from creative and then when we talk about creative, we're creating, and then we're using AI for this as well, as creating multiple options and then running that through and in essence, not only A/B testing it, but now testing at times up to 20, 30 pieces of creative to see which one is pulling the best based on the KPIs that we're trying to achieve for our clients. And we're doing real-time bidding, we're doing optimizing, we're doing customer insights, we're doing deep audience segmentation. We're looking at the client's current customer base and saying, who are your best customers? What do they look like? Household income, location, other psychographic and other interests. And then we're doing lookalike marketing across the internet. So we're serving ads across streaming TV, across all social platforms, across any connected device. So in terms of Ignite, the fastest growing part of this segment is streaming TV. Obviously, streaming TV is exploding, while obviously cord cutting on the traditional broadcast side is, I think at this point, streaming is even more audience than traditional television, and that is only going to continue. And so, taking a step back, we've got this tremendous tailwind of digital advertising growth in the U.S., which is growing at a high single-digit CAGR for the marketplace in the U.S. Then we've got streaming TV growing at a double-digit rate. We've got social growing at a double-digit rate. And we're really benefiting from all of that. When you then layer in the differentiation and being in these size markets, there's not a lot of competition, particularly who can do everything that we can do on behalf of the client. So that's why I think, as you said, it's been on a tear for the last 5 years. It is the fastest growing part of the company for the last 5 years in terms of revenue and cash flow. And that's what we expect over the next 5 years. And we're now being recognized that by others in local media. And we have a media partnership division that we started last year that has started to grow quite nicely. So I think we're very differentiated. We have great growth profile today, but even, I think, stronger in the next 5 years.
Let's talk a little bit about that. You kind of alluded to the white label offering that you have there. You started with that with some initial success, but it doesn't seem like you've kind of pushed down on the accelerator on that, maybe until a little recently. What is your thoughts about the white label portion of that business? Are you kind of ready to scale? Do you think that you're ready to push on the accelerator to ramp up growth there?
Yes, and for those who may not be familiar, so other local media companies are coming to us and they're asking us to do all of their digital advertising, and that includes sales training and then everything else I just mentioned. Creative, inventory buying, audience insights, monthly reporting calls with clients. So it's a very comprehensive partnership. And back in the beginning of 2024, we had one partner. We wanted to obviously test the model. And then about a year ago, we signed up Summit Media, a tremendous radio broadcasting company, private company in about 9 markets. And that's gone tremendously well. And we've actually, I think at this point, we've announced 6 or 7 that we have signed up. Some of those have been announced, but we haven't onboarded them yet. So this year, we expect about $6 million in revenue from just the partners, and that's at a 20% margin. What we've shared is we believe this is going to be a $50 million revenue opportunity at a 20% margin. So obviously $10 million in profit within 5 years. We think next year that $6 million we're doing this year will be 10 to 12 million, if not more. So we're quite bullish, but at the same time, there's a lot of trust involved that we're doing this in conjunction with these partners. So although we're accelerating, we also want to make sure that sometimes we're ready to go faster than a partner. So we meet them where they are. But if you're thinking like we do, we're not thinking about the next 12 months as much as we're thinking about the next 5 years. We couldn't be more excited about this division. And, previously for us to enter a market and sell digital advertising, we acquired radio stations, right? That was kind of using radio as a Trojan horse. We love radio. We'd never have the success we have in digital without that DNA, but we deployed a lot of capital and, acquired in essence, 320 radio stations. But now we don't have to deploy that capital. We may have slightly lower profit margins because they're at 20% here versus mid-20s. But then we could use that capital to delever or buy back shares or whatever we think is the best use of that capital. So as you can tell, just tremendously excited about this opportunity. Really appreciate the partners and their trust. And we think this will be a $50 million division in 5 years.
Obviously, we talked about the great growth drivers for the company, but I do want to touch on the radio a little bit. Given it is a mature portion of your business, you always refer to it as your cash cow portion of your business. I was just wondering, though, as we kind of look toward these Fed rate actions, and of course we're heading into 2026, which is another biennial election year. Do you have some prospects here that maybe you can give us your thoughts about how radio is performing, the trends that we're seeing in currently, and maybe some of the sensitive ad categories? Are they bouncing back like auto, home builders, and the like? And maybe just your thoughts in general about the state of the radio industry and especially the outlook for as we go into 2026.
Yeah, I mean, what's wonderful about radio for those who may not be as familiar with the medium is it's the number one reach medium in the United States today. So when we talk about industry perspective, which is really your question, the fact that we're reaching 93% of Americans on a weekly basis by just listening to AM FM radio, and more people listen to AM FM radio today than 10 years ago, 20 years ago, 30 ago. That's incredible in the world of TikTok and Netflix and everything else competing for people's time. I think that speaks volumes to how much people value radio. What's challenging for the industry overall is time spent listening has been declining. For Townsquare, thankfully, our audience size is solid and our time spent listening is solid, which again goes back to your initial question about being in smaller markets. That's the reason for that. In terms of the industry overall, this year for 2025, I always talk about ex-political, it's performing worse than last year from an industry perspective. And that's true for Townsquare. Last year, we were down 6 ex-political. This year to date, we shared on our Q2 call, it was down -8 versus last year's -6. That's still outperforming the industry. We're actually taking share, just specifically in broadcast. So what I think it's performing slightly worse for the industry at large because it's been a tremendous upheaval year, right? Obviously, a new president, a lot of change. In the beginning of the year, there was a lot of concern around tariffs. I think some of that still sits out there. We don't have a deal with India. The deal with China is not done. So that I think the macro environment has been very challenging, and advertising overall this year, not just broadcast, I think has been muted because of that. We've got tariffs, higher interest rates. Most people expected interest rates to come down further by now. Thank God we got the rate cut in September. There's 2 more highly probable the rest of the year. So I think as we get through the end of this year, obviously now we're dealing with a government shutdown. We had the Doge cuts, which affected some advertising as well across the industry. So as we go into 2026, and again, looking out even further than that, I think the industry decline moderates quite substantially. If the industry overall this year is down 11-12% ex-political, I think that's cut in half next year. And I think that probably even declines even to a smaller decline, and potentially like we have certain markets that are growing, but industry-wide, I think you're cut the losses in half or the declines next year, and I think that moderates over a 5-year period to a low single-digit decliner. I know there's some in the industry who believe it will grow over time in terms of that 5-year period, but and they may be right, but we take the perspective that it's going to be a traditional cash cow, low single-digit decliner when you're thinking about a 5-year. So then the industry is down 12 this year, at least through Q2. I think that goes to -6 next year, probably -3, and then we'll see what happens there. Does it stay in -3 or does it actually start to grow again? But that's what my perspective on the industry. I think it has tremendous attributes. I think the fact that so many people are listening on a weekly basis speaks to the emotional connection that radio has.
Well, if it does kind of get to those growth numbers, as some others are suggesting, that'd be icing on the cake for you, given your growth in your digital businesses. I'd like to kind of get Stu into the conversation. The company is levered, but at more reasonable levels, unlike many of your peers. Stuart, I was wondering if you can talk a little bit about the debt levels at the company. Obviously, you did some earlier refinancings. The prospects to take advantage of possible interest rate reductions as the Fed is kind of lowering interest rates, and what your thoughts are there.
Sure.
Maybe talk about the debt leverage.
Sure. Thanks, Michael. So 5 years ago, we simplified our capital structure by floating a $550 million bond 5 years ago. Earlier this year in February, we refinanced that bond in conjunction with the cash that we built up on our balance sheet of like $70-80 million. And we floated a bank loan, a term loan B bank loan with a variable instrument for $470 million. That was our gross debt. Since then, we've been paying down debt every month. It's a lot easier than trying to go into the market and buy back bonds. We've paid back about $20 million thus far, and we'll continue to do so. We think every year we'll be able to pay down debt to somewhere between $20 and $30 million a year. Things staying basically where they are today. The opportunities to reduce that is as we pay down debt, principal balance that we're paying interest on obviously goes down, so interest goes down. Every quarter point rate reduction that our administration and the Fed gives us equates to about $1.2 million worth of interest expense for us. So we just got one last month. Hopefully you'll get at least 1 or 2 more this year. If not, we kind of expect at least Right now, we're paying SOFR plus 500. We think that, interest rates and SOFR currently is slightly under 4. We think by the end of next year, it should be slightly under 3. So that's a big amount of money. Every point is close to $5 million in interest rate savings for us. In addition to that, we will have the opportunity starting next February to go out into the market and reprice the spread. So to bring that spread down even further. We're currently levered around 5.7 times. We think within the next 18 to 24 months, 4.7 times, sorry.
Yeah.
Thank you, Claire. We think that within the next, within the next 12 to 18, 24 months, we'll be able to get that to the low 4s, under 4. And ultimately, we want to get our leverage down to 3 to 3.5 times as far as leverage goes.
And that's pretty incredible given that many of your peers or some of your peers, I don't even know if you call them your peers anymore, but they're trading at 8, 9 times debt leverage. So 4.7 doesn't sound bad.
Well, fortunately for us, we generate a ton of free cash flow. So we are actually able to delever, which is it kind of distinguishes ourselves from some of the others that we don't consider peers anymore. But it's a very strong attribute of this company today.
And I know that we're kind of running out of time here, but I want to talk about the history of the company's return of capital to shareholders. You bought back a lot of stock. You have liberal dividends. And I just would like for you to highlight a little bit of that.
Sure. Back in 2021, in the month of March, we purchased with $80 million, $12.6 million shares of our equity sponsor, Oaktree Capital Management, at accretive prices significantly below market. It was a unique situation. They had sold themselves to a foreign company, and foreign companies, as you know, can't hold FCC licenses. So it was a very unique situation. We were benefits of that situation, and we took advantage of it. And thankful enough, we had the cash to be able to do that. Then in June of 23, another large shareholder, Madison Square Garden, we bought back half of their shares, about $1.7 million, again at accretive prices significantly below market. And then early last year, in April of 24, we bought back the majority of the remainder of their shares, again at an accretive price below. I mean, we've always been in the market being opportunistic, equally paying down debt, equally buying back shares. Since 2021, we've repurchased 16.6 million shares in the open market at an aggregate cost of $80 million. So we're actively out there, always looking to support the stock in the market, in troubled times and take advantage of opportunities. Also, we have a very high dividend, as you mentioned earlier. At today's, which we think is a very unfair market price, our dividend yield is 12.7% on the current share price today. It's 80 cents a share per year. We've increased that slightly every year for the last 3 years, and we plan on keeping to do that.
What's really interesting is that the stock price obviously has been down, and we have been getting some questions here about that. It's interesting that the stock is kind of tethered to the radio industry, and and the problems that are going on with the high debt leverage of the radio companies, but your stock is trading below that of radio multiples and well below that of digital media companies, but yet you're tethered to the radio industry. What are your thoughts in terms of the prospect of disconnecting from radio and maybe seeing those multiples expand and more in line with what you would say marketing services and digital marketing services companies get these days?
Well, first of all, I think a big portion of that, and the big reason is that we have a very low float. So it's hard for the larger and mid-sized funds to buy into our stock without making a move. That said, as the percentage of our business, which today is 54% and 50% revenues and profits, digital versus total company, as that grows and gets into the high 50s, low 60s, mid 60s, 70s, I think that's